Matt, we appreciate you joining us. I know it's going to be a long day for you. Here's the thing. Of all those things we just mentioned, or maybe something else, what should be the most important? What will likely be the market mover if indeed we have one?
I think it's got to be the Fed. Brian, we had this situation where the bond market has changed quite a bit since late August. I mean, back then, I called for a tradable bounce in interest rates. Everybody was looking for them to go to 1% or lower, but it was only a tradable bounce. Well, now we've gotten that. But the point is, any time we get a significant change in trend, it starts just as a tradable move, and then sometimes it morphs into a more significant one. And with the Fed coming out today, my concern is that this will be enough to take interest rates, long-term interest rates, above 1.9%. That's the key resistance level. And if they can get above there and hold, it would show a change in rates. And that could have all sorts of implications for the entire market, for many different markets.
Will the Fed cut today, Matt?
I think they will cut, but I do think that they're going to their guidance is going to be less dovish than it has been, and less dovish than the money markets have been pricing in lately. And part of the reason is that as much as the Fed claims that they're data dependent all the time, history shows that they're at least somewhat, and quite a bit, market dependent. With the stock market at all-time highs, I don't see them wanting to provide Uber's amount of liquidity at this point. They're already easing. I don't think they're going to go overboard.
So if they cut, then would we expect the equity markets to move, given that you and probably many others believe they will cut? And if they don't cut, would that be a negative signal for stocks?
Yeah, it would definitely be a negative signal, because as much as the Fed is easing right now, and there's no question about that, it's not like we had this time last year when they were tightening and the Fed chairman was saying, well, they were going to tighten forever type of thing. So we don't have that kind of situation where suddenly stocks would get crushed and fall 20%. But it would definitely throw a crimp into the bulls' case and into the bullish case. And this is particularly important because the stock market is right at this key level. You know, we have the S&P slightly breaking new all-time highs. The other major indexes just below them. And each time we've gotten to this position over the last 21 months, the market's rolled back over. So without the Fed helping out in a significant way or in a less impactful way, I think the market would have to come back in and we'd fall back into that range.
You know, you wonder where the volume is, something we've talked about a lot lately here on this program, Matt. I mean, we are seeing the markets creep toward new highs, but on very low volume. Now, our viewers at home who own stocks, they probably don't care about the volume. They care about the fact that their 401k and their 529 and their whatever pensions are going higher. Do we have to be a little bit worried about the fact that there seems to be so little macro reaction to earnings?
Well, yes and no. Yes, because if we do see this a further breakout in a more meaningful one, which will give people more confidence, that should help a volume pick up in a significant way. And if it doesn't, then it would be a much bigger concern than it is now. I think right now is that, again, we're at a significant point in the stock market, we're at a significant point in the bond market, and even in the dollar, which looks like it might roll over, although it's bounced off if the trend channel has been in a while. We have several different markets at key levels, and people are waiting to see what happens. And so it doesn't surprise me that people are kind of sitting on their hands a little bit and we're not seeing the big activity that we'd usually like to see when the market's at testing
all right,
highs.
I'm pulling a homer here because the space that I cover here at CNBC, when is it safe, Matt, to dip back into the oil and gas stocks, which are, by the way, trading at many of the names are trading as if oil was at $15 or $20 per barrel?
Yeah, it's an interesting one that I turned very negative on oil at one point last year that worked out very, very well. And this year I've become much more constructive on the group, and it continues to lag, and it's been very frustrating. The thing is, I think a lot of different groups could suddenly change their stripes in the last 2 months of the year, and the energy prices is definitely going to be one of those. I mean, as you mentioned, the group is way behind the underlying commodity, number one. Number two, it's incredibly underowned, and number three, overhated as well, and of course it's getting relatively cheap. So I think that if we do get any kind of a move higher, up towards $60, one that holds in oil, this is a group that's going to take off because it's so widely underowned, and people have to play catch up as we go through the end of the year.